Hello, everyone. Welcome to the mad world of accounting. I'm your host, Marcus Thomas. Today, we will be discussing the basics of accounting. Before we get into it, please remember to like the video for the algorithm. Okay, here we go. Now, I'm sure the first question you might have is, Marcus, what is accounting anyway? Well, I'm glad that you asked. Accounting is the process of recording, analyzing, summarizing, and reporting financial transactions for individuals and organizations. Accounting is widely referred to as the language of business because it provides a standardized way to record, measure, and communicate a company's financial health, performance, and activities to all stakeholders. So now that we know what accounting is, let's next discuss the basic accounting equation. The basic accounting equation is this: assets equals liabilities plus stockholders' equity. For the equation to work, we must remember that both sides of the equation must be equal. Assets can never be greater or lesser than liabilities and stockholders' equities. If assets are greater or lesser than liabilities and stockholders' equity, then you know that a miscalculation was made. Well, that's it. That is the equation. Now you know why they call it basic. All jokes aside, the basic accounting equation is the foundation for which all accounting principles and guidelines are built upon, so we shouldn't underestimate its importance. Next, we are going to discuss what are assets, liabilities, and stockholders' equity. An asset is anything tangible or intangible that has economic value to its owner or can have economic value in the future. Examples of assets are current cash, inventory, receivables, machinery, or buildings. A liability is a quantity of value that an individual or business owes and is expected to deliver in the future. Examples of liabilities are accounts payable, salary wages payable, notes payable, bonds payable, loans, and unearned revenue. Stockholders' equity is the total amount of assets that a company will retain if it paid all of its debts. Key components to stockholders' equity is share capital, which is the money investors pay for stock, retained earnings, which are accumulated profits by the company. These are not paid as dividends. Treasury stock, which are shares the company buys back from the market, and accumulated other comprehensive income, which are unrealized gains or losses not in net income. Well, that is all for now regarding assets, liabilities, and stockholders' equity. Next, we will be discussing debits and credits and their impact on accounts. Respectively, the terms debit and credit mean left and right. These terms do not mean increase or decrease, but instead describe where a company makes entries in the recording process. When a company enters an amount on the left side of the account, it debits the account. When it makes an entry on the right side of the account, it credits the account. We're comparing the totals of the two sides. An account shows a debit balance if the total of the debit amounts exceeds the credits. An account shows a credit balance if the credit amounts exceed the debits. The illustration shown below is what we in the accounting world call T accounts. T accounts help to show how individual accounts are being affected through everyday business transactions. If you wish to increase an asset, you would debit the left side of the T account. If you wish to decrease an asset, you would credit the right side of the T account. For liabilities, you would credit the right side of the T account to increase it. To decrease liabilities, you would debit the left side of the T account. This is the same for stockholders' equity. To increase, you would credit the right side of the T account. To decrease, you would debit the left side. Now, for this portion of the video, we will go over some practical examples of business transactions and their effects on assets, liabilities, and stockholders' equity. Example 1. Let's say Thomas Inc. has invested $40,000 in exchange for common stock. Common stock is a part of stockholders' equity, so we will debit $40,000 to stockholders' equity. Liabilities are not being impacted in this transaction, so they remain as zero. Cash is an asset, so we will also debit $40,000 to the asset account. Remember, the basic accounting equation states that assets equals liabilities plus stockholders' equity. It is important that both sides equal. Since both sides equal to $40,000, we know that we recorded the transaction correctly. We should also remember that we increased the asset account by debiting it by $40,000, while simultaneously decreasing the stockholders' equity account by debiting it by $40,000 as well. For this example, let's say Thomas Inc. gave a promissory note of $7,000 in exchange for office equipment. Notes payable is a liability account, so we would debit it for $7,000. We would then debit equipment, which is an asset account, for $7,000. The asset account was increased by debiting it by $7,000, while the liability account was decreased by debiting it by $7,000. For this example, Thomas Inc. is paying back the $7,000 for the office equipment. In this case, notes payable will be credited for $7,000 and cash will be credited for $7,000. The notes payable account was increased with the credit and the cash account was decreased with the credit. For this last example, let's say Thomas Inc. received $1,000 for services rendered. We would debit cash, which is the asset account, for $1,000 and also debit stockholders' equity for $1,000. The cash account is increased with the debit and the stockholders' equity account is decreased with the debit as well. So, that is the basics of accounting. I hope that this video helped answer some of your questions regarding accounts and how they are affected by transactions. If you enjoyed the video, please remember to like, comment, and subscribe. Until next time, I hope you have a good day. Thank you.